Good morning, everyone. Welcome to our webinar on liquidity and succession by SES Advisors. This is Jim Steiker speaking. I am the chairman and founder of SES Advisors. We are a firm that helps companies through the ESOP process from beginning to end. What we're going to do on this webinar in the next hour is provide a very general overview of how they work and how they fit into the liquidity and succession landscape. You'll be able to submit questions by instant message, text, should be on your screen to be able to do that, and I'll try and answer as many questions as I can as we go along. So look forward to spending the hour with you. And the first question is, why do we care about ESOPs? For as long as I've been doing this, we've been talking first not about general challenges of liquidity and succession. Privately held companies, of course, have no ready market. I cannot take my shares of Charles Schwab or Merrill Lynch and be able to say, I want to achieve a liquidity transaction. I need to let it happen. And there's obviously a whole menu of reasonable alternatives, and what I should do about liquidity based on what my goals are in the context of what are the reasonably achievable alternatives. And if you talk to most owners of closely held businesses, and one of the fun parts of this is to simply was talking to other people, and now having been a shareholder of SES Advisors, having been a business owner for some time, these are also, when I think about it, my goals as well. And what do I care about, and what does one care about in the ownership of a closely held company? One cares first, obviously, about what are the needs of a potential liquidity transaction. In other words, how big is the check, and how much do I get to pay my friends and local friends? But the second thing one cares about generally is the timing of succession and transfer. This is becoming a bigger and bigger issue as the baby boom generation matures and looks at liquidity as I would have 10, 20 years ago. The most common approach was that there was a retirement date certain, and a founder would look at this and say, I'm going to retire on X date. I need to plan my liquidity and succession around this retirement date. And with the in this generation, and with the technology now having changed well enough that most people can continue to work remotely if they choose to be in another location, or required to show up at an office every morning at 8 or 9 o'clock in the morning, what we have are a lot of folks who don't view retirement as a date certain, but as a continuum. And so many of the folks we speak with look at succession as to how do I move over time from being a CEO responsible for everything that goes on, solving daily problems, being responsible for the daily success of the enterprise, moving toward a board chair, which usually is in the mindset of most of the folks we speak with, the idea that I will cherry pick the things I am particularly good at and that I like to do, and will hand over the more day-to-day tasks to other people. So timing matters a lot for folks in their mindset as much as the actual liquidity event. And of course, we're wrestling with, as we hit an older age, of how do we obtain some diversification of our personal wealth. For many of us, our ownership in a closely held business is a majority, and in some cases, the vast majority of our personal net worth. And finally, we worry about what's going to happen to this business that we've created, founded, nurtured a whole lot. Somebody used to was business was like the mistress, and one of my board members pointed out, having been through this, and said, no, the business is typically not one's mistress, it's one's child. And as a child, we care about what happens to this child very often. There are some folks who this is not a major concern, and whoever buys it at the highest the game. For a lot of folks, they care deeply not only personal success, but about what happens to the enterprise as well. And what do we worry about? We worry about how family members are going to happen, what's going to happen in the business, how do we reward key people, and how do we all of the without continuing to be on the hook. And from there, we get to the menu. What can one do with a closely held business? One can look for external buyers, other people's money, strategic buyers, financial buyers going public, or we can look at internal buyers, family management, partners, or ESOPs, which we're about to cover in some depth, or we can look at liquidating the business, which is mostly an alternative if the assets are worth more than the business is. So then we ask the question, within this menu, what is an overview of a good ESOP candidate? And as we talk about ESOPs more specifically, we'll see why these make for good ESOP candidates. 10 companies that are not particularly cyclical and typically have slow to medium growth. Very, very high growth companies consume a lot of capital and therefore often don't have cash available to fund the ESOP purchase of a selling shareholder. And very, very high growth companies also often offer such potential high returns to the shareholders that they are unwilling to sell them to the ESOP or anybody else. We also look for stable cash flow because we're going to involve borrowing money either from a lender or from the seller to pay for the company's stock, and that requires cash flow. More often than not, we have owners interested in remaining involved and or participating in the enterprise in some way, shape, or form on an ongoing basis. ESOPs are less useful and sometimes less successful as tools when we have an owner who is that proverbial person who is turning 65 and has a ticket to Florida and a golf bag on their shoulder and never wants to be involved again. Typically, good ESOP candidates have ownership groups that have a long-term horizon. They're typically not looking for immediate cash payment in full. If we want immediate cash payment in full, we're usually looking for a third-party buyer willing to pay cash. We're looking for ownership groups that typically have some long-term motives about the legacy or the mission of the company and the employees of the company, so they have intangible concerns in addition to tangible concerns. And most of our ESOP companies tend to be companies that do not have readily available strategic buyers who are willing to pay a significant premium for the company, because in our experience, if one can realize a very significant strategic premium, that will overwhelm very often the other goals related to ESOPs, including the potential tax advantages. And so when I look at this list of 6 items here for good ESOP candidates, it'd be very rare that I don't see 4 or 5 of them in a company that is very serious about doing an ESOP where it's a good idea. In other words, not everybody checks every box here, but this is a pretty good core checklist of what makes for a good ESOP candidate. A little bit of headlines again. What are the reasons that attract or repel people from considering ESOPs? The obvious advantages of ESOPs are that they are a very tax-efficient structure. We'll talk in a little bit and at some length about the tax highlights of ESOPs. People like the idea that the ESOP transaction tends to be a more shareholder-directed process. We're not, on the market with lots of people kicking the tires and focused on us and heavy negotiations. We've identified an internal buyer, and we get to decide in the form of the transaction. Timing is a big advantage, particularly for people who are trying to plan their career as well as their ownership around the company and want to remain involved with the company. And most entrepreneurs, one quickly discovers, are somewhat allergic to the idea of working for somebody else after having created their own businesses and worked for themselves for so long. And ESOPs are an advantage, obviously, in controlling what happens to the company, whether it remains independent and whether it continues to operate and benefit a certain group of people. Why don't people like ESOPs? What are the headline disadvantages, the reasons why people may go running from the concept? First of all, ESOPs are complicated. They are complex. You need to spend time on webinars like this and generally learning a lot about a fairly specific technical process around ERISA and the Internal Revenue Code. ESOPs work poorly in companies that are smaller, don't have a real CFO or higher-end controller, and don't have good internal processes because they are complicated structures and need to be monitored and paid attention to. ESOPs also live in a regulated environment. One subjects oneself to the possibility of Department of Labor audits and IRS audits. These are never welcome terms or welcome ideas. And so we are stepping into not only a complicated but a regulated environment when we do an ESOP and we do an ESOP transaction. And the third core disadvantage people perceive in ESOP transactions is that in order to achieve a complete liquidity event, most often we are looking at the selling shareholders needing to hold some portion of the value of the company in the form of a note, and which is another way of saying very few ESOP transactions are able to be structured where the selling shareholders receive the entire proceeds of the sale upfront and in cash. And we'll talk about that in a little bit. So with these high-level advantages and disadvantages, we're going to walk through a little bit more of the basics of the and what are the moving parts here. We start from the very beginning. This is ESOP 101. So we start out with this is an ESOP. An ESOP is an employee stock ownership plan, not an option plan. There aren't any options involved. An employee stock ownership plan, it is a retirement plan. It's a qualified deferred compensation plan under ERISA and the Internal Revenue Code. And when we say it's a qualified deferred compensation, it simply means that by meeting a bunch of IRS rules and covering a broad group of employees, we have the benefit of being able to make contributions to the plan that are tax deductible to the corporation. These who benefit from those are not subject to immediate taxation. They tax at some point, hopefully far into the future, after they retire or leave the company. So in the broadest sense, ESOPs are similar to profit sharing and 401k plans that are also qualified plans in that they allow a tax deduction for the company now and recognize income for the participants later. ESOPs differ in two critical ways from conventional retirement plans. Conventional retirement plans, like 401k plans, must, under the applicable ERISA rules, be diversified. A typical 401k plan offers dozens of investment alternatives. ESOPs, on the other hand, are designed specifically to invest in one asset class, which is stock of the employer company. In fact, most often, ESOPs only have one asset. They have the stock of the company for which the employees work. So they are an exception to the normal diversified retirement plans that one sees in the world. Secondly, ESOPs can be leveraged. Most often we receive contributions on an ongoing basis to a retirement plan, and those contributions are invested in a conventional retirement plan as they are received. In the world of ESOPs, we can borrow money today from the seller or from a third-party lender via the company, and we'll talk about those mechanisms in a minute, and we can buy a significant block of company stock today and pay for it with future contributions, future earnings from that stock. Why are people doing ESOPs? What are they trying to accomplish? The most common goals in an ESOP transaction are first and foremost shareholder liquidity, shareholders selling stock and receiving some money now or over time in exchange for their stock. Secondly, liquidity tends to drag along the concept of succession. So most often ESOPs are part of a long-term liquidity plan, but also a long-term succession plan. Who will be responsible for the continued success of the company? Thirdly, ESOPs have to do a lot with both corporate and personal tax planning. And fourthly, ESOPs typically have to do with creating an ownership incentive for employees, particularly for key employees. So what are the headline tax advantages that get people to spend time learning about ESOPs? Because very often it's these tax advantages that drive the initial consideration of an ESOP as an alternative to a third-party sale or something else. And firstly, we have with an ESOP the effective deduction of principal on an ESOP loan repayment. What this simply means is that if we borrow money to fund a liquidity event for our shareholders through an ESOP, when we have to pay back that borrowed money, and the problem with borrowed money is that we have to pay it back, we can get a tax deduction via the ESOP equivalent to the principal we repay on the borrowed money. So normally, if I wanted to fund a $10 million liquidity event for a shareholder in a company, I could do it by a leveraged recap, simply borrow money and distribute it to the shareholders. The problem is that if I borrow $10 million to do a leveraged recap and fund a $10 million payment to my shareholders, at some point I'll have to pay that $10 million back. And when I pay that $10 million back, the principal of it, I will have to earn, in essence, about $16 or $17 million of corporate earnings that I will pay taxes on, or somebody will pay taxes on, in order to get $1 million after tax proceeds to pay that loan back. In an ESOP transaction, because I will get tax deductions equivalent to the principal paid, I will only have to earn $10 million to repay that $10 million I've borrowed to put $10 million into the hands of our shareholders. The second key ESOP tax preference, which we'll discuss in a minute, is the ability of a shareholder who sells stock to an ESOP if the company is or becomes a C corporation. That shareholder can potentially defer the capital gains otherwise due on that sale to the ESOP. And we'll talk about how that works in a moment. Third headline is that if a C corporation pays dividends to the ESOP on the shares held by the ESOP, and the ESOP uses that dividend to repay debt, those dividends are tax deductible to the corporation that pays the dividend. And we'll talk about why that's important in about a minute. And finally, we get to the alternate universe and what is often the big headline these days about ESOPs. If we are an S corporation and we have the ESOP as a shareholder in an S corporation and accounts as a single shareholder, then the corporate income attributed to the ESOP as a shareholder is not currently taxable to the ESOP as a shareholder. In other words, the ESOP gets a K-1, its attribution of corporate income, and unlike any of us individually who then have to pay taxes individually on that attributed share of corporate income, the fact that the ESOP is a tax-exempt pension trust means that it's not required to pay taxes currently on its share of S corporation income. I'm going to talk in a few minutes about how all of these things work and some transaction structures that reflect these tax advantages in the actual process of an ESOP transaction. So let's go specifically to capital gains deferral. Capital gains deferral applies in a C corporation, and it permits a shareholder to sell to an ESOP and indefinitely defer capital gains tax on that sale. The rules of the game here are that the ESOP must own 30% of the value of all company stock after the sale. That's why we see a lot of 30% ESOPs. And the selling shareholder, in order to defer that capital gain, must purchase what we call QRP, Qualified Replacement Property, which is defined in Section 1042 of the tax code to be stocks or bonds of any domestic operating corporation. There's some specific rules and twists and turns in there, but basically this is essentially the idea here is that shareholders in a closely held company get one bite of the apple in which they can do the equivalent of what we see in real estate as a like-kind exchange. They can sell stock in their held company to the ESOP, and if they buy an equivalent amount, probably of a diversified set of stocks or bonds, they've been able to pay at least the capital gains tax that would have been due otherwise on that sale of stock to the ESOP. Now, you only get to do this deferral one time. If you sell the stocks, or you have a year to buy the stocks or bonds that are going to be your qualified replacement property, but whatever you buy within that year gets the basis for tax purposes of what you sold to the ESOP, which is usually a low basis. And if and as you sell those stocks or bonds, you recognize the capital gain that you deferred when you sold to the ESOP. So you get one shot to basically reinvest the proceeds of the sale from the ESOP into something else. And of course, for many folks, the goal then may become to buy a good diversified portfolio where all or most of what you buy can be held for a long time and ultimately pass into an estate where you get a step up in basis, and then you've deferred the gain permanently. So that's the quick summary of qualified replacement property. There are some special securities that are often used as qualified replacement property called floating rate notes. This is not the 101 course on ESOPs, this is the 201 or 301 course, but they are a special security that people use to gain more liquidity and more trading ability within the process of buying qualified replacement property. So this capital gains deferral, now that capital gains rates at the federal level are effectively 23.8%, and there's a lot of state capital gain tax out there. Pennsylvania is one of the few states in which you can't defer the gain in 1042, but pretty much everywhere else you can. Deferring capital gains has become a much more significant issue over the last couple of years. As we said, let's talk quickly about the headlines of S corporation ESOPs. And as we said, in an S corporation ESOP, the income is attributed to the shareholders in an S corporation. S corporations do not pay taxes. They are a pass-through entity, and their shareholders pay taxes. The corporation holder pays no taxes on its share of corporate income because it is a tax-exempt pension trust. One can easily see here how one achieves a sort of tax nirvana, which is to say, if we have the ESOP as the sole shareholder of an S corporation, we have an entity that does not pay taxes at the corporate level because it is an S corporation, and we have a shareholder that does not pay taxes because it is a tax-exempt pension trust. Hence, what we've done on a current basis is create taxes effectively at the same rate as the United Way. It does not pay, essentially a tax-free entity on a current basis. If we are an S corporation and remain an S corporation, we do not, however, have the ability to elect capital gains deferral under Section 1042. So in our perfect world, we find occasionally C corporations where the shareholders can sell to an ESOP, elect capital gains deferral, and then convert to be an S corporation and gain this benefit of being, if they are 100% ESOP owned, being effectively tax-free. Let's talk about how an ESOP works mechanically. And we'll do it in words, and then we'll do it probably more usefully in a moment in pictures. And the first thing is a company establishes an ESOP trust. This is a trust for the benefit of employees. It is similar to a 401k pension trust or a profit-sharing pension trust, basically an ERISA trust for the benefit of employees. This trust will purchase stock from either individual shareholders or newly issued shares from the company. The financing will typically come from the bank or possibly the selling shareholder to buy the shares. The company will fund the ESOP with ongoing benefit plan contributions or perhaps with dividends on the stock that the ESOP owns that the ESOP will use to repay debt. And of course, down the road, the employees will now gain allocation of shares, and we'll talk about how that works in a minute. And at some point, the company or the ESOP is going to repurchase those shares from employees at some point and over some period of time after they leave the company. So let's look first of all at one common form of an ESOP transaction. And this is, we imagine a company that is or becomes a C corporation looking to have the ESOP buy a minority interest in the company, where we anticipate that that shareholder will elect 1042. And we're probably going to use a convertible preferred stock, and we'll talk about that in a moment. And these are all a mouthful, of course. First of all, many of you probably S corporations, most but not all of the time, on full analysis, it will make sense for that company to become a C corporation for a while if we're going to do this kind of minority transaction. It's a longer analysis. It's a little counterintuitive, certainly from what one hears from most business and accounting folks, but that is where the analysis will tend to take you. And let us imagine here that we have a company that is worth $10 million. And how do we know it's worth $10 million? ESOPs, for better or worse, are not Priceline. We do not get to name our own price. When the ESOP is going to purchase stock from the company, there must be an independent appraisal of the value of the stock that the ESOP is going to purchase from either a shareholder or from the company. So let us imagine here that we think our company is worth $10 million, and our goal is to accomplish a $3 million transaction for roughly 30% of the company, maybe even a little bit less. And the first thing we're going to do is we're going to borrow some money from the bank. And in this case, let's imagine we go to our friendly banker and we say we would like to borrow. In this case, I'm going to give you the example of $3 million. And the company is going to borrow $3 million from the bank. And of course, what does the bank want? They want two things. They want to see enough cash flow that they think they are likely to be repaid by the company's cash flow. And they would like to know what they can grab and sell if we don't. So they want a note plus a collateral. What do we do if we're like an engineering firm or we're a firm like mine where the assets are a few desk chairs and computers? We'll talk about that in a moment. So our company here has borrowed $3 million. And our company now has $3 million of cash. So far, we haven't done any damage to our company balance sheet. We have the $3 million of cash offset by a $3 million liability. We are now going to turn around and make what we call an inside loan. We're going to turn around and loan the cash to our ESOP, and we're going to receive a note payable from our ESOP along with a pledge of the stock that the ESOP is going to buy from the shareholder. So this looks like a cash out note receivable from the point of view of the company received from the ESOP. It certainly has the appearance that we've done no damage to our balance sheet because we have offsetting assets and liabilities, but unfortunately that is not the case. In an ESOP, the SOP 93-6 and its successors require the company to account for the note receivable from the ESOP not as an asset but as a contra equity account. Reason being, the only way the ESOP's going to get money to pay the company back is from the company. So essentially, we are going to make our balance sheet look ugly in this ESOP transaction. Do we care? Most often we do not. Most companies have nobody other than their bank looking at their balance sheet for the purposes of credit, and the bank is going to understand this as an ESOP transaction. The exceptions, of course, are companies that do have to do financial reporting to other people. These things like construction companies that may have bonding relationships or distributors that may have manufacturer relationships. These are the kinds of companies that are going to have to do some level of explanation to those folks to help them understand the ESOP transaction. So in our example, we now have the ESOP with $3 million of cash, and that we're going to have that cash paid over to the shareholder in exchange for stock. And here is a problem, which is if our company is worth $10 million, how much stock should the ESOP be able to buy for $3 million? And our intuitive answer is 30%. Our problem is that our appraiser is going to look at that and say, wait a minute. From the ESOP point of view, we're buying a minority interest in the company. We shouldn't be paying based on a $10 million valuation. We should be paying based on a minority interest value. And in this simple example, $3 million of the might be a percentage, 30% of a $10 million control valuation, but it would be a higher percentage of what might be an $8 or $9 million minority. This is where our tax-deductible dividends come in, because we're often going to have the shareholders sell to the ESOP not ordinary common stock, but a special class of convertible preferred stock that has a special dividend, recognizing that when the company has to hand the ESOP money, whether that money is a contribution, it's tax deductible. We also know that because of our special dividend deduction, the dividend is going to be deductible. And the way this is going to flow through, and I'm not going to go into too much detail here, is the convertible preferred is going to act as an offset to our minority interest discount. We may not end up in a 75-25 ownership position here, but we probably will end up with a $3 million transaction in a company with a $10 million valuation where the ESOP gets 30% of the stock based on effectively the majority control valuation rather than having the impact of the minority interest discount. So this is a bunch of structuring and alchemy when all is said and done. ESOP loan repayment. Well, the company has to pay back the bank, and if we borrowed $3 million over a 5-year term at current kinds of interest rates, we're probably handing the bank $600,000 of principal each year, and probably handing them in round numbers another $120,000 of interest. And we know when the company hands the bank the money, the principal is not interest tax deductible. So I did tell you that the principal would be tax deductible here, but it's not because we're paying it to the bank. Remember that what we're doing at the same time that we pay the bank is we're handing the ESOP money, because remember the ESOP is a benefit plan and it requires contributions or dividends, and we're handing the ESOP not coincidentally usually an amount equal to the amount we're paying back the bank. And and so it looks like the money's leaving the house twice. We're paying the bank and we're paying the ESOP. remember that the ESOP owes the company a boatload of money. The ESOP borrowed money from the company to buy stock from the selling shareholders. So when the company writes the check to the ESOP, this money is going to make a round trip and come right back to the company as a loan payment. Net result is that the contribution and repayment between the company and the ESOP is effectively a non-cash transaction. The cash is moving in a circle. However, when we handed the money to the ESOP, we got a tax deduction because we qualified plan. But when the ESOP handed the company the money as a loan payment, that was a return of principal. So what we have going on is we have a non-cash tax deduction related to the company funding the ESOP that offsets the cash non-deductible principal payments from the company to the bank. So when people say that principal is deductible in an ESOP transaction, this is how and why. The result of all this money that we contribute to the ESOP is that stock that the ESOP purchased initially, which was initially fully encumbered, held in a suspense account because when the ESOP bought $3 million, it's still $3 million to the company. Now, as we've paid back some of that loan, we've received a contribution and paid it back, some of that stock is now owned free and clear in the ESOP, and those shares are typically allocated to the active participants in the ESOP that year based on the relative compensation of those ESOP participants. So the stock the ESOP buys isn't allocated all of a sudden in one big lump to employees. It's allocated as and when we repay debt over a number of years. Here is the next slide, which is a fairly complicated slide, and we're not going to cover it in great detail here, other than to say, how do we do a 100% transaction for an ESOP? And the answer is we borrow some money from the bank, and we give the shareholders a note. And in our C Corporation transaction and in our S Corporation ESOP transaction, we're doing the same thing here. At the end of the day, if we want to become a 100% ESOP-owned company and end up as an S Corporation, typically when we do that, and have a company that will operate tax-free, we're usually going to borrow some money from a bank, whatever we can get the bank to comfortably lend us. If we have a $10 million value company, that might be $3 or $4 million. And from the point of view of the selling shareholder, we're going to pay for the remainder of their stock with a note. Now, that's counterintuitive for most business owners. If anybody gets any advice from accountants and lawyers, it typically will be to the effect of you don't want to sell your company for a note. Why is that? Most notes are pretty junky. They have two problems with them. They don't pay very much in the way of a return, and most seller notes don't give you any rights to control the company that has to pay back the note. In these ESOP transactions, we do things typically a little differently with these seller notes. First of all, one of the goals is to get our selling shareholders a total return commensurate with the risk of providing this seller note financing. And typically we get that by first giving them an interest rate, which may be a relatively low interest rate, 2, 3, 4, 5%. But then we also tend to give our selling shareholders warrants, which are like stock options, which are basically a piece of the future value of the company. So in an example of a typical structure we might see in a $10 million company, the selling shareholder might be getting $3 or $4 million in cash at a closing. We'll be holding a note for the balance of $6 or $7 million, but may have attached to that note warrants for 20 or 30 or 35% of the value of the company in the future. So in other words, the shareholder is getting a carried interest in the future performance of the company in exchange for providing the seller financing. So it's essentially a recapitalization. Those warrants will be largely taxed as capital gains, and they are a pretty favorable instrument. It's a pretty good thing to have a warrant in a company that's going to pay down debt and isn't going to pay any taxes. So for a lot of selling shareholders, they evaluate their transaction alternatives and say it is better to be in part a note holder in this tax-free company rather than be an equity holder in a taxable company, particularly when you have a warrant for a good piece of the equity of the company. The second thing we're going to do is attach governance rights to this note. And in those governance rights, we're going to usually give our selling shareholders the ability to nominate some or most of the board of directors of the company, and often to serve on the board of directors of the company until the note is repaid. So we've typically answered the two fundamental objections people may have here, which is how do I get a decent return for holding this seller paper, and how do I make sure I have enough control to make sure that the company actually repays this debt. And typically the rates of return we see all in, including the warrants on the seller paper, typically translate into an internal rate of return between 10 and 15% for the selling shareholder. And what we're going to then do is put all the stock into the ESOP, typically over a very long term. And the idea is that the ESOP will be the 100% shareholder of the company going forward, but the stock will allocate to employees relatively slowly so that we have an ordinary and appropriate level of benefits for employees. So when we talk about game plan, this is essentially our game plan for how we are going to become 100% ESOP-owned S Corporation. I'm going to pause for a minute and see if anybody has any questions via the chat window that they would like me to address in this, and whether this is relatively clear. Seeing none. The typical visions that we see in an ESOP transaction, what are people trying to do? We most often see people trying to do the ESOP in pieces, one or more capital gain deferral transactions to transfer most or all of the stock ownership to the ESOP. Often what we're seeing in either partial ESOP transactions or whole ESOP transactions is outside of the ESOP some form of synthetic equity, usually some kind of stock appreciation right or phantom stock being given to key management so that our key people will own somewhere between 15 to 30% of the economic value of the company on the long term outside of the ESOP. The idea being that we will use these other items to make sure that management has an enhanced ownership. And this usually deals with a situation in which a lot of folks ideally would have loved not to do an ESOP, but to do a management buyout. Management always would like to figure out a way to buy the company on their own. Problem very often, of course, is that management doesn't have any money. Very few companies have paid their management well enough that management can turn around and make a cash offer for the company. So the net result is management has to evaluate whether it's best to mortgage their houses, cars, spouses, and children to buy stock directly when they'll have to pay that debt in after-tax dollars, or to go forward with an ESOP transaction where the ownership is shared more broadly. The tax advantages of the ESOP drive the transaction, and management essentially gets a significant stake in the company directly without having to put up any personal guarantees or their own money. And typically the goal here in the long run in these several transactions is to eventually become 100% corporation. Our alternate vision is to go do this in one fell swoop. to become 100% ESOP-owned S corporation in a single transaction by giving the current shareholders some mix of cash and subordinated notes. Again, we're going to have synthetic equity for management, and we're going to use our S corporation tax-free operation to accelerate our debt reduction and our ability to deleverage relatively quickly. So when we're putting together an ESOP transaction, what are some of the things that we have to focus on? First and foremost is valuation. What is the company worth? We have to look at financing. Can we borrow money at an appropriate level and rate to fund the cash portion of the transaction? How does the ESOP fit into our overall employee benefit structure? What are the legal and fiduciary risks and issues? And we have to deal with the cost of the ESOP and complexity. And, we look at a company pre-ESOP, which is a conventional company with shareholders, board, appointing officers, overseeing management, and overseeing employees. This is our traditional company. Post-ESOP, our existing shareholders is now in part an ESOP, or in whole an ESOP, governed by an ESOP trustee appointed by a board of directors, and the employees participate in the ESOP. And one of the questions always is who should be and who often serves as an ESOP trustee. And pretty much whenever we see either a change of control transaction, the ESOP owning a majority of the company, or a minority interest transactions that's north of $3 or $4 million, we're usually seeing at a minimum for the transaction an independent party serving as the trustee. Why is that? There's fiduciary risk associated with making the decision to buy stock. It's also very hard for insiders to have the sophistication and independent-mindedness to act on behalf of employees and represent employees in buying stock from existing shareholders, particularly when those existing shareholders are often their bosses. The good part about independent trustees is we're shifting some risk and we have professionalism. The bad part is they do like to be paid for their services. Talk about ESOP valuation. ESOP valuation must be by an independent appraiser on behalf of the ESOP. That means that the appraiser, who is a financial valuation expert, is working not for the company, is not a neutral arbitrator, but is working for the ESOP as a buyer of stock from the selling shareholders. And they should be advocates, if you will, for the ESOP trustee, reporting as the buyer. That means it's very important for the company and the selling shareholders to understand somebody ought to be on their side of the table structuring the deal and proposing an asking price, because we don't normally sell anything by letting the buyer's expert determine the price solely. We have to have a negotiation. Valuation in an ESOP situation, as in all other closely held cash flow, it's the perspective of a financial buyer, meaning somebody is buying the company the way it currently runs and is operating. They're not buying it for the ESOP is not a strategic buyer where there are synergies and somebody is paying for the company not as it is but as it might be. So we're typically seeing, and we're doing analyses when we help companies look at valuation for sale to an ESOP. We're using data about what private equity firms pay for companies, because private equity firms are financial buyers similar to a ESOP in this purpose. We're looking about whether a minority discount or control premium applies. We're looking at marketability discounts, and we're looking at whether to use a dividend-paying stock. Typically, the key language in valuation is EBITDA, earnings before interest, taxes, depreciation, and amortization. We look at a multiple of EBITDA, and there's a lot of data out there. I would say most ESOP transactions in the lower half of the middle market, transactions between $5 and $50 million, tend to be at valuation multiples somewhere between just about 5 and into the low 6s. There are exceptions in all sorts of situations, one way or another. But we take a multiple of 12-month trailing EBITDA, assuming that it represents a fairly normal and not unusual performance. We take a reasonable multiple, often good to start with a 5.5 or 6 multiple as a back of an envelope. We then subtract any outstanding debt of the company. We add assets owned by the company not used in the business. Most common is a cash value of a life insurance policy. Perhaps we have other things. Perhaps we have cash on the balance sheet that's significant. Obviously, there's a lot of subtleties that go into the specifics here, but this back-of-the-envelope approach will usually get you into the right neighborhood and at least begin to shape some expectations. We get ESOP financing typically from the existing bank we deal with. That's most often the best source. Sometimes we make them compete by going to other lenders when we're either not happy with or not securely attached to our incumbent. Brokerage houses will do some lenders, seller financing is a possibility, and we can go off to the non-bank groups and the specialty financing people, some of whom charge exorbitant rates but may be providing a higher level of financing than otherwise available. Talk for a few minutes now, flip from the financial side to the ESOP plan design issues. How do we design our ESOP as an employee benefit plan? And typically the issues we have to address are eligibility, allocations, vesting, distributions, and the like. The shorthand is our ESOP will generally cover all employees who work more than half time, work more than 1,000 hours in a year. Typically they will enter the plan within a year, more or less, of starting employment. There's some specific choices there. All of those employees as participants will participate in the annual allocation of stock or any other contributions in the plan that are freed up as a result of our debt repayment. That allocation will most commonly be 95% of the time in proportion to the relative compensation of plan participants. That means if I make $20,000 and somebody else makes $100,000, they will get 5 times as much stock in the ESOP as I get. The requirements to participate in that allocation will be to work more than 1,000 hours in a year and typically to be employed on the last day of the plan year. In order to get to keep my ESOP benefit, I need to become vested. I need to work for a certain length of time. The maximum vesting periods permitted in ESOPs, as in other qualified retirement plans, is either a 6-year scaled vesting system where one vests 20% after 2 years of service, and then 40 after 3, 60 after 4, 80 after 5, and 100% after 6 years of service. Or I can have a 3-year cliff vesting, no vesting for 3 years, and 100% vesting after 3 years. Most companies use scaled vesting rather than cliff vesting. One of the key design issues is whether I will credit service for vesting purposes prior to the establishment of the ESOP. That's a choice. I'm not required to do it, but I can do it. For companies that have provided a good retirement benefit over time that they're continuing to provide, they will view the ESOP perhaps as an additional benefit, and they may start the vesting clock anew by not particularly giving people any vesting credit. If the ESOP is fundamentally a replacement for a prior plan or the idea of creating a retirement plan that in some way really recognizes people's long-term service to the company, then we will typically provide some or full credit for prior service in determining vesting. And we often see full credit. We often see partial credit where people get up to 2 or 3 years of credit so that they're not fully vested on day one, but they're ahead of somebody who just got hired yesterday. So if I enter the plan and I participate in the ESOP and I receive stock allocations and I work long enough to be vested, when do I get to turn my ESOP stock into cash? And the 4 primary events that determine when I can go to the pay window and turn my stock into cash are death, disability, retirement at a normal retirement age, usually 65, can be lower, can't be higher, or otherwise terminating my employment with the company. In the first three events, death, disability, and retirement, the maximum periods, and these are the periods usually written into the plan initially, tell me that I am entitled to receive the value of my ESOP stock over a 5-year period, beginning the year after the year in which year of death, disability, or retirement. So it's a 5-year payout, and the payout typically varies with the performance of the stock. I get 20% of my stock each year. What happens if I am 45 years old and I decide I want to, go fishing or fund, buy a new truck or start a competing business? Well, you don't really have to be your employee's venture capital provider. The ESOP benefit become available to somebody who terminates prior to normal retirement until 5 years after they leave the company. And after that 5th year, they receive their benefits also over a 5-year period. So it's a relatively longer period of payout for people who leave prior to retirement age other than for death or disability. Who votes the company stock held by the ESOP? The stock is held in a trustee. In a trust, the legal shareholder is the trustee. Trustee is the only person that can attend a shareholder meeting and receive, financial information about the company as a legal right. Employees have the right to direct the trustee to vote the shares allocated to them for certain major kinds of corporate change issues that don't come up very much: merger, dissolution, liquidation, recapitalization, reclassification. There are 7 of them specified in the code. None of them come up very often. We are permitted, but we are not required to let employees direct the as to the voting of stock for election of the board of directors. Many companies don't do this because it's a lot of paperwork. Some because they want employees to feel and act like owners. And typically, if we do let employees vote for directors, we're giving them a public company style where they can score against the directors that are nominated. So that's our voting of company stocks. It's very important the trustee ends up with a lot of power here. What do we do to accomplish an ESOP transaction? Typically, the first stage is what we call a transaction study or a feasibility study. And this is not to determine whether typically you can do an ESOP. Most folks who want to accomplish an ESOP can do so, and the folks who we don't think can accomplish it will tell well before we do a feasibility study. But the goal of a feasibility study is to say, will an ESOP address and meet the needs of the company and its shareholders, and what will it look like? What will the likely valuation of the company be? What will the financing structure be? What are the right moving parts that will make the ESOP work and function for the benefit of the company, the shareholders, and the employees? And if we go through that process, typically then we proceed, we'll enter the world of looking for the financing, getting the independent appraisal and the trustee process, designing our ESOP plan, documenting all of the documents in connection with the ESOP transaction, hopefully to arrive at a closing where many trees will have given their all in service of creating a mountain of paper that will reflect the transaction and all the pieces. The only government approval required in an ESOP transaction is an approval of our plan document, an IRS determination letter, which is typically applied for after the transaction and is pro forma. There is no regular government approval of the ESOP transaction terms themselves. The DOL looks at this typically by audit, which are random. They claim to audit a lot of ESOPs. I would say, a significant number of our companies have gone through Department of Labor audits. In representing companies and ESOPs for 25 years, we've never had the Department of Labor challenge a transaction or determine a fine or penalty for a transaction that was a prohibited transaction or improperly done. There is a lot of audit activity. There is some litigation. Your best litigation protection is to do reasonable and appropriate ESOP transactions and not to do exotic and aggressive transactions. Ongoing ESOP items, we need an appraisal update every year. We have to figure out what the stock is worth. We have to do annual record keeping and administration. What we have to tell our participants is how many shares are allocated to their account, what those shares are worth, and how much they are vested. We don't have to disclose any company financial information. However, a lot of ESOP companies do utilize some open book techniques in one way or another. We have to figure out how we're going to fund over time purchases of stock from people who have left the company and are entitled to payout. And we have to deal ultimately with how we're going to communicate the ESOP, tell our employees about it, and we have to do some ongoing legal compliance to keep our plan documents in compliance, similar to the way we have to do for 401k and other plans. With that, we're about at the end of our time. I think we've more or less hit the mark in terms of being an hour. I'll be happy to take any questions offline. Feel free to call where we can be helped. We thank you all for your patience. I know it's a challenge to listen to these webinars sometimes from a voice far away and looking at a computer screen. Hope this has been useful and look forward to talking to any of you who may find this helpful and useful. You have my contact info. As I said, happy to help anybody for whom this becomes relevant or interesting. Have a great day. Thank you.